Hello, in this lecture we're going to continue on economics and economic reasoning, chapter 1. Remember that our objectives and our goals are going to be to define, we have defined economics, discuss ways in which economics use economic reasoning, explain real-world events in terms of economic forces, social forces, political forces. So remember that economics is a social science. We're going to study human behavior in different conditions, and so we have a guide to reasoning. So Steve Levesque's bestseller Freakonomics contains many examples of thinking like an economist. So here's some examples within this book that to think like an economist that may be outside what most people really apply economics to. So here's one situation, uses economic reasoning to explain why people become drug dealers. So the potential benefit of selling drugs is much higher than the cost of giving up the minimum wage job. And note this is an area that does create like a political debate in many areas, and that is that when we think about drugs and the legalness or illegalness of drugs, we are talking about markets, and when we make things illegal, oftentimes we create a black market or something where goods and services could be sold that are not part of the standard market, sold illegally. And what are the causes and effects of that? And we've seen this in a couple different ways. I mean, in the past, we've seen this if we think about the prohibition in America of alcohol. We could think that there were good intentions on the pro side. Obviously, they were trying to help people not to have problems with alcohol. But of course, what happened at the same time, that when we measure the pros and cons to the society as a whole, is that it could have been that it increased in terms of violence and or illegal behavior, and possibly increased time for jail sentences and illegal behavior on people's records and whatnot for alcohol. And the question is that worth it? I mean, what are the pros and cons to the society of this happening? And we need to be able to measure them. There's good points on either side. If we bring that to the present, we have the same things with the war on drugs, especially things like marijuana is a current debate that people are both on both sides of the aisle on that. And again, the same thing. I mean, if we want the item to be not legal, that's of course people are going there with good intentions, that they don't want people to be abusing themselves with a substance. And of course, on the other side of the aisle, you have the people saying, well, it could be causing a black market. The black market could be causing more violence in terms of this, because it creates a higher incentive for people to enter the black market, because it drives up the cost of the drugs, and therefore incentivizes people to take on the risks in order to do that. And what are the costs to basically, again, people's records and jail times? Do we have a lot of people in jail for what some might think are not a reason for high jail sentences in terms of drug usage and this type of things? So the economics within this is a huge factor in some of these kind of issues that a lot of people don't understand well enough when we're thinking about how we want to make decisions on our social policies. Marginal costs and marginal benefits. So these are going to be basic economic terms we want to keep in mind like all the time when we think about economics. So using, and we do most of the time, we know these types of terms intuitively, and now we just want to know them more officially when we think and talk about economics. So using economic reasoning, decisions are often made by comparing marginal costs and marginal benefits. So marginal costs are the additional costs over and above costs already incurred, and the marginal benefit is the additional benefit above and beyond what has already occurred. Now again, this is how we generally make decisions already, and we basically assume that people are making decisions where the marginal benefit is greater than the marginal cost to them. We as economists assume that is happening, and now we're just basically making formal terms of that. So when we think about the marginal benefit, I do want to point out that we're not thinking about dollars necessarily, and that's something that used to always kind of confuse me when we thought about these things. When we think about accounting, we're thinking about dollars. That's the cost of goods and services, and we're really so used to thinking about dollars as a measuring tool that we don't even know that we're thinking about dollars as measuring tools. So a dollar is a unit of measure that is somewhat standard, even though it kind of fluctuates with like inflation. But when we think about marginal cost and marginal benefit, there's many other things that are going to be influenced in terms of what a cost is and what a benefit is. Our time is a cost, and the energy that we put into something. And different people could have different ideas of what is a marginal cost and benefit to them. So a problem that we have here is we do not, at this point, we haven't defined, and we'll talk about how to define at a later time, what unit of measure to measure something. Just realize that the unit of measure is not necessarily dollars, although dollars, the cost, the price of something could be a factor. It's not the only factor. But if you can theoretically think about units, some type of unit of measure, then as long as we're making the next decision, if our marginal benefit from that decision is greater than the marginal cost, then we should make the decision. And if we think about that in terms of if we were at a place and it was really expensive, we were buying slices of pizza and we're starving, and the slice of pizza was $20. The first slice we would buy because we're starving, and the second slice we may not buy because now the marginal benefit we're going to take from the second, it may not be worth the cost. In that case, the cost being a dollar amount, but the marginal benefit being the benefit that we receive from it, which is measured, well, I don't know. It's just, if we pay for it, then we're assuming, as economists, we assume that the marginal benefit of the person buying it is greater than the marginal cost. So marginal cost and marginal benefits. So the economic decision rule, of course, then is if the marginal benefit of doing something exceeds the marginal costs, do it. So this seems really basic, and it is really basic. When we write it out in a formula like this, though, it can seem kind of abstract at the same time. So remember that we assume that people do this. People, when we observe people, whatever they do, whatever decision they're making, if they're buying stuff or if they decide to go somewhere or something like that, we're assuming that to them, their marginal benefit is greater than their marginal cost. That's why they're doing it. And so we're basically going to put that in the formal terms. We don't know, again, we don't know what the measure is. We don't have a formal unit for it. But in theory, that would be a reasonable assumption. If that's what someone is doing, that decision that they're making on the margin is greater than the cost on the margin. And if the marginal cost of doing something exceeds the marginal benefit, then don't do it. So of course, if something costs more in marginal cost than the benefit, then we would not do it. All right, so opportunity cost is another term in economics that we need to define. And we do have an intuitive sense of this one as well. So opportunity cost is the benefit foregone of the next best alternative to the activity we have chosen. So this could be the cost, not in terms of dollars again. So whatever we do, there is a cost. And when economists say that everything has a cost, it's a common term, like everything has a cost, most people think of that in terms of dollars because we're just so trained in thinking in terms of units of dollars. When economists say that everything has a cost, it doesn't necessarily mean a dollar amount cost. Dollar amount costs are a factor. How much it costs in dollars is one unit of measure. But when we think about economic terms, that's not the only unit of measure we're going to have. For example, even if we got a free movie ticket to go to a movie and we went to the movie, we still have the opportunity cost of the second best alternative that we could have done with basically the 3 hours at the movie. If we went to the movie, we couldn't be home studying, or we couldn't be at the beach or whatever. That second best choice is what we gave up in order to do something. So there's always going to be some type of opportunity cost. And again, as economists, usually we often make the assumption that if someone is doing something, such as we're watching this movie now, then we assume that that's their highest benefit. We assume to them, however they're measuring their benefit, watching the movie is their highest benefit, and the cost of them doing it would be the second best thing that what they would have chose to do second to watching the movie. And again, you might say, well, that's crazy. Some people do things that aren't worth doing. That isn't the highest good thing, but that's kind of the assumption we're going to make most of the time. If you're doing something, the cost of you doing it is the thing that you didn't do, and most of the time we're saying, well, if someone's choosing to do something, then that's their highest good, however they measure that. All right, so we have opportunity cost should always be less than the benefit of what you have chosen. So that means the cost of the second best thing you could have done shouldn't exceed the thing you are doing. Otherwise, it would be an irrational decision to do what you're doing. And obviously, the assumption that we usually make are people are rational. Therefore, the thing that they're doing is the highest benefit to them. So opportunity cost is the basis of cost-benefit economic reasoning. Note that when we think about the cost-benefit, we often think of dollars. We think about accounting costs in that terms. And so when we think about accounting costs, notice what is not included in the accounting costs when we think about dollars is often the opportunity cost. And that's often when we make complex decisions, that's often the thing that we need to add into the picture, the thing that we need to make sure that we are considering when we're making decisions. So opportunity cost examples. So we could have individual decisions such as the opportunity cost of college includes items that you could have purchased with the money spent on tuition and books. So anything we spend money on, we could have done something else with that money. So the assumption is if we're spending money on tuition and books, that's the highest good to us. And the opportunity cost is whatever else we could have done with that money, including buying something else and or putting it into the bank or some other investment and earning returns on it. But note that we also have the loss of income for the full-time job. So I mean, if we were not going to the school, then we have the opportunity cost of the time that we're putting in, and that time could be spent somewhere else, such as a job. So those are the two factors that are costs of school. Government decisions, opportunity cost of money spent on war, on terrorism is less spending on healthcare or education. So same idea. If we're thinking about spending, where are we going to spend the money? If we're thinking about spending money, what's the highest area? If we spend it in one area, the opportunity cost is the cost that we forego in order to spend it in another area.